Hello again, I'm Luca Sarri. I'm one of the founders of Sarri Statham Investments. I'm here with Ravi Lockyer, our head strategist.
Morning.
For another edition of our video analysis, and we're going to speak about Lloyds, the Lloyds results today.
Yep.
So firstly, what are the good points
about
today's numbers? These were the end of year results.
Yes. Well, look, focusing on the business exclusively for the moment, the company's reported quite a sizable increase in its net interest margin, moves up 23 basis points to 2.63%, which is a very large jump in the margin, which is surprising given the very low level of interest rates at the moment, relatively stagnant credit demand, which one would suggest would see a reduced interest rate margin. So they've done well on that front to squeeze more margin out of existing loans.
Okay.
They've cut costs very nicely. There's been a 50 basis point reduction in the cost to income ratio to 49.3%, and reported a very high underlying return on equity, which is 15% before charges and exceptional items, which was a rise of 1.4 basis points. So that's pretty good in terms of the core business. Obviously the stock has seen its earnings come through, earnings per share north of 8p, which is also positive on an underlying basis.
Okay. In terms of targets that Lloyds have set itself, what are they looking to achieve?
The board have cited a continuing reduction in cost to income, saying that the ratio is going to fall to 45% by the end of 2019, which entails around a 9% improvement from 2015. We can envisage this happening primarily through further branch rationalisation, staff rationalisation, plus the impact of one or two of the changes that Lloyds has put in place in recent years. They've guided to common equity tier 1 capital generation of around 2% before dividends. So using the closing capital of the end of 15 of 12.8%, there would be almost 15% by the end of 2016 before dividends, which is a significant rate of capital growth. Obviously capital retention will depend on the dividend, more on that later. And they forecast a further 7 basis point improvement in net interest margins from 2.63% to 2.7%. So that's an important target for sustaining earnings growth in 2016.
Okay. PPI, I noticed there were continued provisions for PPI in there. I mean, what's the story with PPI? Are we near the end, or we've got more to come?
Well, today they've announced that the Chief Financial Officer has made the statement that given certain assumptions, he expects that the existing provision, which is £16 billion in total, which was increased by £4 billion in 2015, should be sufficient to deal with the outstanding PPI expenses. As PPI expenses are incurred, the provision is run down. As that happens, the bank increases the provision to take on board likely further expenses. So in 2016, they've increased the provision to 16 billion, but they've also said that they think that this total provision will be sufficient to cover all PPI liabilities. So one would read from this statement that given the assumptions they've used, we would not expect further large PPI provisions going forward, which is obviously very important because the PPI expense at 4 billion is just under half of the company's trading profit. Okay.
Any concerns over these numbers? Anything that you didn't like that was in there?
Okay. I thought the obviously the movement in the tangible net assets, which is key for understanding the valuation of the bank, fell 2.6 pence over 2015 to 52.3p. The company is very sensitive to charges on that, and they've included a sentence which says if we update the tangible net asset value per share as of yesterday, we get to 55.6 pence. But that still leaves the stock after today's, this morning's jump in the price at a 23% premium to its tangible net assets which is higher than other banking peers, most of whom are on very substantial discounts to the tangible net assets. This reflects Lloyds' expectation that capital will grow quite strongly in forthcoming years. One could also point to the lower deposit level. It would appear that the company has seen some impact from challenger banks in that the deposits have fallen a little bit, 1% over 2015. Could it be that challenger banks are attracting deposits as well as current accounts? There's also a very large drop in risk-weighted assets, 7% to 223 billion. I would question whether or not that is sustainable in the current environment going forward. Probably risk-weighted assets will come down slightly more, but probably not too much more.
Okay. A couple more things, Ravi.
Yeah.
Government share sale has obviously been delayed. Does this change anything?
Well, this is positive for the government share sale because obviously we get nearer, after today's rise in the price, we get nearer to the government cost per share, which is thought to be around 73p per share. It seems that the government was very correct to delay the share sale.
Yeah.
Now, one would expect them to get a better price. In terms of the timing of the share sale, I don't see this as happening before the referendum. I would see this as happening later in the year, certainly in the second half of the year. I wouldn't like to guess whereabouts, but maybe
still
Q3.
Likely for this.
I would say it would happen this year, yes, but not in Q1, possibly Q3, possibly Q4.
Okay, great. So today we hit our target price, which was 65p. I think we've gone some way beyond that. We're about 68p last time I looked. Does that change your view? In light of these results, are you inclined to change your view? Or
we're certainly keeping Lloyds under review. I think these results today were strong on a number of points. This is a fast-moving environment, as everyone knows, for the banking sector. There have been significant changes so far this year in the sector and in expectations of profit growth over 2016. There are significant broader risk factors pertaining to banks. Lloyds is different in that it's almost uniquely UK as opposed to the other peer group. I would expect Lloyds to be a simple story over 2016, one that benefits from the continued UK growth rate in GDP. Also, putting in place this cost savings, they are deliverable in my opinion. The plan is deliverable. And that buys it a lot of credibility. Relative to the peer group, I think this is an important growth play still.
Okay, excellent. That wraps this session up for our video analysis. Please join us next time when we'll be looking at other companies reporting.
Thank you
very much.
Thanks.